Imagine having $4 million and being told that you can't get a mortgage. That's something that actually happened. I heard it this week while I was recording a podcast with a wealth management firm I partner with. The advisor told me about one of his clients, $4 million in liquid assets, extremely strong balance sheet and zero debt problems, and he got turned down for a home loan. My honest reaction was, no, that guy could have totally gotten approved, easily. The money was never the problem. The lender was the problem. If you have assets, but your income on paper doesn't show the whole story, stick around. You're going to want to hear this. I'm going to show you the exact 2 ways that a person gets approved for a mortgage loan. And I'm going to put some real numbers on the screen so you can see it for yourself. So here's what happened to the client. He lives off of his portfolio, which is what a lot of wealthy people do. He's not pulling a W-2 paycheck, and his tax returns are intentionally written to be tax efficient, which is exactly what a good wealth advisor builds. So when a traditional lender looked at him, they only looked for one thing, monthly income on paper. And they didn't find a number that fit in their little box. No steady paycheck, no big taxable income, denied. The lender simply treated a multimillionaire like he was broke. That's not a money problem, that's a product problem. So here's the part that surprises a lot of people. Your assets can count as income. There are loan programs built specifically for such a person who is rich in assets and light in income. The industry simply calls it asset depletion or asset utilization. The idea is very simple. The lender just takes your liquid assets, runs a formula, and turns that balance into monthly qualifying income. You don't need to sell anything or liquidate any stocks. You don't need to hand over your accounts. Your money stays invested. It is only used to prove that you can make the payment. And there are 2 completely different doors to walk through. Most lenders only show you door number 1, and a lot of them show you none. Door number 1, the conventional route. Fannie Mae has a program where assets become qualifying income. Here's exactly how the math works. They take your net eligible assets. That means they start with your liquid investment and retirement accounts, then subtract the money that you need for down payment, closing costs, and reserves. Then they divide what is left by 360 months, and that number is your monthly qualifying income. So on a $4 million portfolio, say you set aside roughly $200,000 for the purchase and the reserves. That leaves about $3.8 million. Divide that by 360. That is over $10,000 a month in qualifying income on paper with no job. And the trade-offs you need to know. The loan to value is capped at 70, maybe 80% if the account owner is at least 62 by closing. It's a loan product specifically for a primary residence or maybe a second or vacation home or a limited cash out refinance. The upside is that you get conventional loan rates, which are usually some of the best pricing that's available. So quick pause. If you have assets and you want to know what you would actually qualify for, here's the next easy step. DM me the words asset on Instagram at Steve Conti Pro, and I'll send you my asset qualifier cheat sheet that breaks down which accounts count and how the math runs. Or if you'd rather just talk it through, the link to book a call is right in the description. Now, let me show you your door number 2, because this is where it gets a little bit interesting. Door number 2 is what's called the non-QM route. Non-QM stands for non-qualified mortgage, and it just means that it's not a Fannie Mae loan, and it's a different set of rules. Same concept though, but a little bit different math. On this path, the lender takes your net eligible assets and divides by 60 months instead of 360. Same money, 6 times the qualifying income. And watch what that does to our client. Same 3.8 million, divide by 60. That is over $60,000 a month in qualifying income for a home purchase with no job. That can support a loan well into 7 figures. And this door, it opens a lot wider in a few ways. There's no age requirement. You don't have to be near retirement. It can be used on investment properties, cash out refinances, not just a primary residence. No W-2 needed, no tax returns required. The trade-off? There's always one. Now, what's the trade-off? Of course, I'm going to be transparent. There's always a trade-off. The trade-off in this case is the interest rate. Non-QM pricing typically runs somewhere around 0.5 point to 2 points higher than conventional, depending on the file and the overall credit profile. So door number 1 gives you the best rate with some tighter rules. Door number 2 gives you much more buying power with a slightly higher interest rate to offset the risk. The right answer simply depends on your goal. That's the whole job. For 18 years, I served as a firefighter and a paramedic. And I learned that the difference between a good outcome and a bad outcome is almost always preparation and the person standing next to you who actually knows what they're doing. Mortgages are no different, believe it or not. That $4 million client did not have a money problem. He had a preparation problem and a wrong person problem. The lender he called didn't carry the product, did not know the math, and certainly did not ask the right questions. So the answer was no. So let me explain exactly who walks through these doors. Retirees living off of a portfolio. Early retirees who hit financial independence young and they just don't have a W-2. Self-employed owners and business owners whose tax returns are written lean by design. Real estate investors living off rental and investment income. Maybe people who just received a large settlement or a divorce payout. Trust beneficiaries. And high net worth buyers who keep their money working in the market instead of sitting in cash. If you are any of those and a lender ever told you no, there's a very good chance you were just sitting at the wrong desk. This is the same concept behind a video I did on DSCR cash out refinances, where investors pull equity out of a rental without ever using a W-2. I will link it. If you're an investor, watch that one next. You won't be disappointed. I also broke down why self-employed borrowers typically get denied for mortgages and how you can fix it before you apply. That one pairs perfectly with this. The link is below. A few things that you should know so you do this right. Not every dollar counts the same. Checking, savings, and most investment accounts usually count at or near full value. Retirement accounts get treated more carefully. If you're under 59 and a half, those funds often get a little bit of a haircut because of early withdrawal penalties. Once you have penalty-free access, more of that money counts. And you're still going to need some reserves left over after closing. Your assets typically need to be seasoned, which just means that they've been sitting in your account for a few months, not just parked there yesterday. And remember the rate trade-off. The non-QM door costs a little more in rate for a lot more in that buying power. And the most important thing, you do not have to liquidate anything. You keep your portfolio invested and working for you. The assets are only there to prove that you can pay. That's it. One quick note, I'm not your financial advisor. These are general numbers to show how the programs work. Your real number depends on your accounts, your goal, and the lender. And that is exactly what a real conversation is for. So here's the bottom line. That $4 million client was never the problem. The lender just did not have the right product or ask the right questions. If you're sitting on assets and you're tired of being told no by people who do not understand your particular situation, let me show you your real numbers. Go ahead and start your application. The link is right in the description. It takes a few minutes and there's absolutely no pressure. And while you're here, tap that subscribe button because the next video is going to save somebody a deal that they thought they couldn't get. I'm Steve Conti, and I'll see you in the next one.